All right, at this time I'd like to introduce our next speaker is Adam Halpern and Matt Bowen from Indicator Warehouse. And they've really got an interesting company that they've put together, and I'm excited to have them on the Trading Pub today. They're going to talk to you about how you manage the risk is everything. And I think that that is more important now than ever. Okay, if anybody has been watching the market the past week, you know that people aren't focused so much on how can I make the most money, but how can I manage my risk. And Adam, if you get a chance at the end, maybe just tell them a little bit. I know you guys have been working on a new project, and it's kind of interesting. If you think about trading, there's a lot of different parts to it. And you know, some of the things that you've got to decide whenever you trade, you've got to figure out when to get in, you've got to figure out when to get out, and you also have to figure out how to manage your risk. And what Adam has done, and this is something I find very interesting, is he's really worked at Indicator Warehouse to put something together to kind of bring all those things under one roof. And so I think he'll probably tell you a little bit about that at the end of his presentation. But Adam, at this time, I'll turn it over to you and appreciate you and Matt taking the time to join us this morning.
Thank you. Thank you very much, Morgan. And I'm really excited to be here. I love the fact that we have such a terrific turnout early in the morning. I've already done my miracle for the day. I somehow got my family out of the house at 8:30 Central Standard Time. So I feel like George Costanza. I've done my thing, and now it's just coasting from here. I also want to thank Ninja. If for those of you that don't know about Indicator Warehouse, we are 100% dedicated at NinjaTrader. If they didn't exist, we wouldn't exist. And so without further ado, I'm going to give you a quick overview of what we're about. I don't have to cover this again because it looks like Morgan already did that for me. So I just highlight in yellow what I think is probably the most important. This is risky business, and there is an opportunity to lose money. So hopefully it doesn't happen, but it is a reality. So I put this up here because I want to give you a little overview about what Indicator Warehouse is all about. I was talking to my wife the other day, and I said, I feel like I'm working in a Wild West movie. And the day trading business is full of all the villains and white-hatted cowboys, and of course, like the Wild West, a lot of snake oil. And so I started out as a novice trader, like many people that are probably in this room. Spent my proverbial amount of money that you have to do in order to kind of get ahead in this game. And so when I launched Indicator Warehouse, I really wanted to do something different. And so what I did was I called all of the certified NinjaScript programmers that are on Ninja's page, and I said, look, you guys are programmers. You probably don't really enjoy dealing with the general public. I'm a sales and marketing guy. I do. Why don't you let me sell your stuff for you? And they were more than happy because they just want to sling code. My customers are more than happy because now we have this single resource in which to find really innovative trading tools. And of course, I'm happy because I had this business idea that everyone seems to like. So we fall somewhere in the middle, right? So we're not this large forum that gives away everything for free and then makes their money on advertising. But on the other hand, because not everything is for free, we have the kind of revenue that allows us to hire really quality people to help install the products, to help support the products, to help educate on the tools, and also to continue to develop quality tools as we improve them. So it's not just about getting it for free, it's also about getting the support you need in order to get this up and running and get back to what you wanted to do in the first place, which was trading. So we're very old school about our customer service. We don't hide behind a web form. We don't hide behind an email. Our telephone number is right up there, right up front. We want you to call us. Matt, who you're about to talk to, has been in the business for 20 plus years. He's my age. He absolutely prefers the telephone over anything else. So with that, I'm just going to give you a quick taste, no pun intended, of what Morgan alluded to earlier. The day trading sandwich is a concept that I came up with about 6 months ago, partially because I love food and partially because I love trading. And the idea was that there is no one perfect tool. There is a perfect set of tools, and just like any sandwich you may make, there is no perfect sandwich, right? You put the ingredients together that you liked for your type of sandwich and to meet your needs. So Matt's going to go into all this in detail. I don't want to steal his thunder, but this day trading sandwich concept is something we're definitely building on, and you'll be hearing more and more about it in the future. So with that, I want to introduce you to Matt Bowen. He came on board a little over a year ago, literally grew up in the industry. If you're talking about a veteran trader, then that's Matt. So he's going to cover the day trading sandwich and really give you a deeper understanding of what we're trying to do here.
Okay. So everybody wants to be a profitable trader, but very few do. It's been 24 years for me, and it's been one wild ride. And I can tell you that this is probably, for many people, one of the most frustrating things they'll ever do. I've worked with just about everybody from CEOs to taxi drivers, garbage collectors, you name it. The one thing that I can tell you about traders is that intelligence is not a factor and will not determine whether you are a profitable trader. What will determine that is your discipline to follow a set of rules, because in this business, everything changes. Nothing stays the same. Over the years, I've worked with a number of profitable traders, and one of the most consistent themes that I've seen are 4 rules, and I'll give them to you. And I would say that these are cardinal rules, so you might want to write these down. Of all the profitable traders that I have seen, these are the rules that keep coming up over and over. And if you want to validate this, you can go get a book called Market Wizards. It was written in the late 80s, and it interviews, I think, 16 or 17 top traders at that time. And one of the most consistent themes that kept happening over and over when you read the book is you find out that traders, all of them use different strategies, okay? So the strategy is not that important. What is important is that you manage the risk, because one thing that you learn from each one of those traders is that they consistently never risk more than 1% of their capital on any one trade, okay? They may use several different, you have people that are trend followers, you have people that use Gann, Elliott Wave, Fibonacci. You'll run into people that are using astrology. It goes from one end to the other. You'll see people that are using indicators that they have made, borrowed, chewed up, and put together themselves and put them back together that way. But the bottom line is that you end up with 4 rules that almost every profitable trader will use. And here's number 1. Trade with the trend. When I started working with hedge funds, one of the first things that I noticed on their charts was they were always looking for trends. Now that can be on a daily chart, a weekly chart, a monthly chart. It could be on a 5-minute, a 1-minute, a tick chart. Doesn't matter. They're looking for a trend, because you have to understand something. These guys are dealing with a ton of money, big money, and they can't move it. Picture yourself with an oil tanker next to a jet ski, okay? The jet ski can move around and do circles, but the oil tanker can't. So these guys have to strategically find a trend and then ride it. Hopefully it will continue, okay? We don't always know that that's going to happen. Sometimes they do, sometimes they don't. But once you get on board one, I will start to explain to you why this is important later on. The number 2 rule, cut your losses short. When you're not right on the trade, get out. Don't play with it. Don't rationalize. I've worked with enough traders over the years that I've seen them do everything in the book. And one of the worst things that you can do is average a loss, not get out of the trade when you're supposed to. The rationalization game that gets played by traders is just, it's phenomenal. A guy will have a 2-point stop on a stock, and the next thing you know, he's taking a 15-point loss because he's, as it goes down, well, it'll come back. I'll just wait one more point, and it just keeps getting bigger and bigger. It's like a snowball going down a hill. So you've got to cut the losses short. When you're wrong, get out. Number 3, when the trade's working, let it run because you don't know how far it's going to go. You don't know how far it's going to go. Nobody does. If they tell you that they know, walk away. They don't know. No one knows whether the next trade's going to work. But when you get on one that does work, you have to let it run. Because if you risk $100 to make $300, that's a 3-to-1, okay? What we call in the book an R multiple. An R multiple is nothing more than a unit of risk based on your return. I'll show you that in detail in a little bit. Number 4, got to manage the risk. And the way we manage risk is position sizing. This is another concept that came up in Market Wizards consistently. Position sizing is what dictates how many contracts or shares that you put on, whether you're trading stocks, forex, futures, commodities, doesn't matter. Position sizing, that is probably the most important concept to a trader, because if you ask around and you talk to most traders, what you find is that they're trading 1 and 2 contracts and they're leaving a ton of money on the table. I'll show you that in a minute. So there you have 4 cardinal rules, and I hope that you wrote those down. I'll give them to you again. Well, number 1, trade with the trend. Number 2, cut your losses short. Number 3, let the profits run. And number 4, manage your risk. Those are critical. Without those, you really don't have a chance because you're going to be all over the board. And if you look around, most traders are all over the board. Their equity curve is just, it looks like a yo-yo. It's back and forth, and at the end of the year, by the time they pay commissions, they have nothing to show for it. So it becomes an expensive venture. Okay, so let's get on here and take a look at what we're looking at. As Adam alluded to earlier, we have what's called the day trading sandwich, and I'll bring this up just so you can see this on the screen. It's going to consist of 4 tools, okay? We have what's called a risk manager, the ultimate trailing stop, boomerang, which is our signal to get in and out of the market, and then we have something called an FMA. And what that is a trend indicator, so it tells us whether we're going to be long or short in the market. So we have 4 things that we're looking at, okay? So let me minimize this. Let's get back on the screen, and I'm going to give you some examples of what we are looking for with a particular trade. Now, you can read the comments that are on the charts. Please take a look at those. What you're looking at here is, I'll explain these red lines, okay? On the chart, this is referred to as a GMMA. It's the same thing as the FMA. It's just different colors, and then we have a free version that we give out to people that use Boomerang. But what this is as I talked about in our cardinal rule number 1, trading with the trend, the red lines here, these are longer term moving averages, okay? And if you've ever worked with some serious traders, what you'll find is that they typically will use cross-referencing of 2, 3, maybe even 4 different time frames. So what they're doing is they may line up a daily chart with a 60-minute and a 15-minute and then a 5-minute or a 3-minute. They want to see all 4 of those going in the same direction, okay? There are several reasons for all these lines that are on here. These are very long-term averages. In other words, what this allows me to do is it allows me to see a much longer-term price action without having to cross-reference all those charts. So instead of me looking at 4 different charts, I can use these lines to tell me what's going on short-term and long-term. Okay, so just think of it this way. These red lines are long-term. I cannot trade against it. So if you see a buy signal right here, just like this one that you see here, you cannot take that trade because the red lines are moving down, okay? Think of it as a river or a waterfall. If you try to go against that, it doesn't work most of the time. And you'll see people trying to pick tops and bottoms, and ultimately they end up getting chewed up. They may tell you otherwise, but if you ask them for a year's worth of results, you get a different picture, especially when you start to look at their equity curve. All right, so we had the long-term averages. Now we're going to look at the blue lines. These are very short-term averages, and I can only take trades that are in the direction of both of them. Now, what's critical about this process is that it filters out whether or not we take any trades with boomerang, okay? Boomerang is simply the signals that you see on the chart. They're going to be blue arrows and red arrows, okay? So this tells us when we see both of them moving down like this, we want to be short. We're only going to be taking short signals. Now, one of the critical processes about this is that the blue lines you need to pay particular attention to, because these need to be falling down as well. I don't want to see them jackknife or go up before they descend. Okay, I'll show you some pictures of those and why we pass up a lot of trade setups. This is a great filterization process, and when you get on board one of these trades that starts to work, this is how you really pocket the money. Okay, so you've noticed on this signal that both the blue lines and the red lines are moving down. Boomerang has given us a sell signal on this bar. So what I'm going to do is I'm going to click on the bottom of that bar, and then I'm going to click on the top of that bar. That's going to be my risk. That's my initial risk going into the trade. So this particular trader has a $10,000 account, okay? You can see that right over here. Excuse me. And if you come over here on this chart over here, you can see he's risking 2% on the trade. So he's only going to risk 2% or less. He doesn't have to risk the full 2%, but it can't exceed that. So if he's got a $10,000 account, he can't trade more than $200 because that would be more than 2% risk on his account. So you see over here, $160 is the amount that they're risking on this, and you're doing 4 contracts. Okay, remember me talking about most traders doing 1 or 2 contracts? Here's another case. Why do 4? Well, 4 is telling me that the distance between the low and the high, okay, if you measure that in terms of dollars, I can only get in 4 contracts, because if I do 5 contracts, it's going to exceed my $200 threshold. That's why we limit it to 4. If I was able to get 5 for 200, then you would see 5 in here, but you don't. So we're only going to be able to do 4 because it's going to be more than $200 if I do 5 contracts. All right, now the next step in this process is once the trade is taken, once we get a bar that goes below there, we're going to do a market order and get in. We're not going to dance on there and try to get the best price. Get in. You can ask questions later, but you need to get in, because if you miss the move, guess what? You got to go get another trade. So once the trade is initiated, we're in, we're short. Now I want you to pay close attention to these red dots, okay? These red dots down here are telling us something, and it's a very important piece of information because this is part of managing the risk. Once the red dots get below our entry, and you can see the entry point right there is 791.30. Once the red dots get below there and we have not been stopped out, we then use the red dots as our trailing stop. So every time they move down, we move the stop down, okay? And as you can see, what happens is it actually keeps you in the trade until, bam, you get stopped out. So you got in, you were short at 791.30, you were exited at 786.40, okay? Now, what does this all mean? We ended up making $1,960 and we only risk 160, okay? So if you do an R multiple or risk comparison to your initial risk, you see that that was a little over 12 to 1. So You know, most traders will say, well, what does that mean for my account? Well, you could take the next 12 trades, lose on every one of them, and you would still be ahead for the day. So this is very critical, because when you trade like this, you don't need to be right 90% of the time. Most traders out there are trying to be right 80, 90% of the time. This is fantasy land, folks. It doesn't happen. And if you can get, if you're an ex-floor trader or somebody that's standing on the floor, uh, that might be the case. You might be able to do it. But I'm telling you, I've been working with on-the-screen traders for well over 20 years. There isn't one person I can pick up in a Rolodex and say, hey, George, you know, I know you're trading at 85%. Can you teach my students? They're not out there. It doesn't happen. And I'm going to show you why you don't need to play that game. Because another thing that I see with traders out there today is they're doing some scalping techniques where they're risking 6 ticks to make 10, or, you know, and this stuff, it doesn't work because you don't let your winners run. If you don't let your winners run, how are you going to pay for the losers? That's the question you have to ask yourself. This concept came up when I started working with a hedge fund, because I started asking a lot of questions myself. You know, why do we have to have this trend in place? And because they're not trying to get in and out of a market. They want to ride it for as much as they can. And they may be looking at a chart that looks just like this, same amount of bars, and the bars may look exactly the same, except they're looking at a 60-minute chart. Okay? They may be looking at the same thing on a 60-minute chart. And that brings up a point. You can do this on, you know, like I said, dailies, weeklies, monthlies, 60-minute, 30-minute, tick charts, range charts. We're looking at range charts here because most people are short-term traders, and when you do use the range charts, it's going to give you plenty of opportunities during the day. One thing that you have to understand about trading: when the setup is there, you put it on, you take it, and you manage the trade. You let it go. Most people don't have a problem getting into the market. They really don't. They can get into a trade pretty easy. But here's the thing: in trading, you only make money 2 ways. And it's the position sizing and then managing the trade, which consists of your exit. So, I kind of laugh because there's so many people put so much emphasis on to getting into the trade, and then once they get into the trade, they don't know what to do with it. Kind of like taking somebody fishing the first time, and they get a fish on the line, and they're like, okay, well, now what do I do? So the concept is the same. You just want to follow these dots. The dots will tell you where to get out. The setup will tell you where to get in. And again, one of our most important parts is how many contracts do we put in? If you were talking to Tom, Dick, and Harry down the road, they would probably be doing 1 or 2 contracts. And instead of getting $14.50 on a trade setup, they'd get $145, and then they would go on to the next trade. Well, you see how much money you're leaving on the table there? Okay, if he was doing 1 contract, he's going to make $145. If he's doing 10, he makes $14.50. So see, the position sizing is one indicator. I don't even like to call it an indicator because it's part of your trade setup, but it's the one tool that we sell, called the Risk Manager, that literally multiplies your money. And that's what it does. It literally multiplies your money because it tells you, look, you don't want to put 1 or 2 contracts on. You need to put 10 on, and your risk, because the thing that you have to understand is your risk is always constant. It never changes. That's why we see this risk down here. It's telling you 2% risk. You're not allowed to take more than $200 on this trade. That's the most you can lose on this trade. So what does this do? Well, it frees you up from all the anxiety of trading, because when you're getting into the trade, the most you can lose is $200. That's it. You set, as soon as you're in that market, you're setting that stop. We get hit, bam, we're out of there. Do I care? No, I don't care, because it's just a trade. Go on to the next one. It's like a bus stop. 15 minutes, there'll be another bus. You can get on that one. Plus, if you're trading in different markets, like let's say you got crude oil, gold, the euro, and the NASDAQ or the Russell, You only have to wait a few minutes before you get a setup, okay? It doesn't take long if you're trading multiple markets.
Okay. Yeah, sorry about that, folks. Not sure what happened, but so here's what I recommend. Clearly, there's a lot more to talk about. Um, if you go to Indicator Warehouse /sandwich.htm, there is a prior video that we did that talks about some of the same concepts, and you're welcome to contact me. So I'll put my email down here below in a second. And again, I apologize that we didn't get to finish this out. It's a very interesting topic. Matt's really the guy that turned me on to risk management, and when he came on board and showed me what it was all about and position sizing was all about, not only did it change my own personal trading, but I thought it was just going to be a game changer for the industry. So with that, I thank you all very much for being with us today.